Okay. I'd like to call the meeting to order of the Norwalk Pension Board. And is there approval of the minutes from the last meeting? If we could see who is here.
Hi, Frank. It's Judy Archer. I'm here.
Excellent. Why don't we, I'm going to kind of almost call a roll call. Charlie, you here? Joe? Rich?
Both Joe and Rich are here. I can see them.
I'm here and I'm unmuted.
How's that? Is
Oh,
that better?
Okay, we're all unmuted. Is there a motion to accept the minutes?
I motion to accept the minutes.
Is there a second?
I second.
All in favor?
Hi.
Aye.
Opposed? No. Motion passes unanimous. Is there anybody logged on who would like to make a public comment? They could do so now. If not, we'll,
There's one person, Kari Fairchild. Kari, if you'd like to speak, please raise your hand electronically now, and I will unmute you.
Kari is a member of the board.
Oh, she is?
Yes,
Okay, so you want me to move her over to panelists?
yes, please.
Okay. All right, so there are no attendees from the public.
Excellent. So we will move on to the next topic, and that's approval of pension applications. Is Jerry on?
Jerry's here. Can you hear me?
Yes, I can. If you'd like to go
Okay.
over them.
I'd be happy to. We'll start with David Archer. This is actually a resubmission. He was approved for Social Security disability benefits. So we have moved him to the standard option and a revised monthly benefit of $2,982.98 retroactive to his commencement date. Next, we have Charles Mace, 12 years, 7 months of service, age 58. His is an early retirement. He elected option 1 with a monthly benefit of $1,107.57, annualized to $13,290.84. Commencement date is July 6th of 2020. Next is Kim Gibson, 32 years, 8 months. She's 58. She elected early. The standard option with a monthly benefit of $3,308.96, annualized to $39,707.52, effective July 2nd of 2020. Next is Sharon Kubel, 30 years, 11 months. She's 66. Hers is a regular benefit. She elected the standard option with a monthly benefit of $3,492.40, annualized to $41,908.80, effective July 16th of 2020. Next is Marcy McKee, 32 years, age 73. Hers is a regular pension. She elected option 2. She elected the standard option with a monthly benefit of $3,361.63, annualized to $40,339.56, effective July 15th, 2020. Next is William Newton, 25 years, 6 months, age 66. His is also a regular pension. He elected option 2. Monthly benefit is $2,112.33, annualized to $25,347.96, effective July 14th, 2020. Next is Karen Doyle Lyons, 19 years, 6 months, age 75. Hers is a regular pension. She elected the standard option with a monthly benefit of $1,929.74, annualized to $23,156.88, effective July 21st, 2020. Next is Catherine Braun Lossberg, 5 years, 8 months, age 64. She elected a regular pension. option 2, with a monthly benefit of $504.49, annualized to $6,053.88, effective July 2nd of 2020. Next is Vanessa Barros, 10 years, 2 months, age 62. Hers is also regular pension. She elected option 3. Her monthly benefit is $741.19, annualized to $8,894.28, effective July 1st of 2020. Next is Linda Goldman, 16 years, 7 months, age 71. Hers is a regular pension. She elected option 2. Monthly benefit is $1,470.91, annualized to $17,650.92, effective August 1, 2020. Next is Robert Barron, 8 years, 1 month, age 62, a regular pension. He elected the standard option. His monthly benefit is $2,192.08, annualized to $26,304.96, effective August 16th, 2020. Next is Barbara LaConfora, 45 years, 5 months, age 66. Hers is a regular pension. She elected option 1. Monthly benefit is $3,631.69, annualized to $43,580.28, effective August 8, 2020. Next is Doretta Hilliard, 15 years, 10 months, age 65. Hers is a regular pension. She elected the standard option. Her monthly benefit is $1,447.32, annualized to $17,367.84.
45 years.
Effective July 14th of 2020. And last is Stanley Schuler. His is also a resubmission. He was approved for Social Security disability benefits. So he has moved to the standard option, and his revised monthly benefit is $2,584.32, annualized to $31,011.84. So these are all of the pensions that have accumulated over the summer months.
Could I ask a question on the Barbara Lincoln Fora? Could you tell me what the
Yeah.
annual amount is again?
I'm sorry, I didn't hear what you said, Frank.
The annual amount for Barbara Lincoln Fora?
Okay.
The annual amount, what is that?
It looks like $21,790.20.
Right.
No, that was revised.
That's what-
You might have an older, you might have an older worksheet because her monthly benefit is $3,631.69, and annualized, that would be $43,580.28.
Right, because it did seem
Okay.
very low for somebody who'd been there since they were
Yeah.
21 years old for 45 years. All right, thank you.
Yeah, I thought Helen sent out a revised worksheet. You may not be looking at that one right now, but her monthly benefit is higher than what was originally on the original spreadsheet, Frank.
Perfect, thank you. And the disability, we, as noted in your packet, they're both have been approved by Social Security, correct?
Yes, in fact, with the backup paperwork, you should all have copies of the SSDI award letters.
Perfect. Now, is there on these pensions, the first pension for David Archer, Judy, there may be a conflict of interest?
Yeah, I'm gonna abstain from voting.
Okay,
Tell
thank
you
you.
guys that once you started the voting process, I'm not gonna vote on any of the pensions. I'll abstain.
Okay, well, we could just do one and then the rest if you'd like to do it that way, or else you could abstain.
However is easy for you, Frank. It's up to you.
Okay. Is any discussion with the pensions? And if not, is there a motion to approve? Joe,
Motion to approve as stated.
a second?
I'll second.
All in favor? Aye.
Aye.
Hi.
Opposed? With one abstention?
Yes.
Judy Archer abstains from the vote.
Okay.
Next, performance review.
Hey, Frank, it's Jim Hendrickson. I joined partway through that. Sorry I'm late.
No problem at all.
All right, thanks, Frank. I'm going to try to share my screen here, and Tom will cover the market environment through the second quarter, ending June 30th, 2020, and then we'll dive into pension performance.
Perfect.
Can everyone see my screen here?
Yep.
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 Great. Tom, are you,
I'm here.
you want to take it over?
Sure. Thanks, Britt. I'll start and then Britt will cover some as well. And I hope everyone's doing well and your families are well in this strange time. So I'll start on the market environment slide. If you can go to the next slide. This is showing the performance for the year. So this is good for the fiscal year for Norwalk and also for the quarter. And we'll show one other slide to help visualize the rapidity of the decline from peak to trough for the S&P and then the recovery that we've seen. So this is showing numbers as the end of June 30th, and you can see the returns. The Russell 3000, that's the broad US equity index, it was up 22% in the quarter. It ended up positive for the year at 6.53%. Non-US markets, the developed markets were up 15.34% for the quarter. They were still negative for the year, negative 5.4. Emerging markets also up over 18%, but negative for the year, negative 3.39. And then fixed income ended with a really strong year. So it was up again Q2, 2.9% and 8.74 for the year. And then if you look at the alternative asset classes, the NCREIF property, that's a property index for real estate, slight decline in Q2 of 0.99%, then up 2.69 for the year. Hedge funds were up for the quarter, 6.2%, but down for the year, negative 0.73. And private equity, remember there we're looking at lagged valuations, but that was down 7.8% and then up 2.12 for the year. So for all the volatility, if you look at that 1 year set of numbers, it's not nearly as bad as you would think, I would say. So what's happened, we've had a lot of fiscal stimulus and monetary stimulus from the Fed, cutting rates to zero and instituting all kinds of programs. So we've definitely seen a disconnect at this point between what's going on in the real economy. We have depression-like unemployment numbers and what's going on in markets. These are numbers as of last night. The S&P was up 4.49% year to date. The NASDAQ, that's been the top performer in equities, up 27.6%. That's even with the recent correction there. And then we've seen a very big dispersion between growth and value. So as of the end of June, it was the biggest dispersion ever on a 3-year period between the Russell 1000 growth and value. And even within growth and value, a lot of deviation by sector. So sectors like technology doing much better than sectors like energy. So to give you a couple numbers, year to date, the S&P Information Technology Index is up almost 24%. Contrast that with the S&P Energy Index, which is down almost 43%. So there's a huge bifurcation that we're seeing between growth and value, and also by sector. It's not a traditional recession area environment because of the pandemic. We've had parts of the economy have lower activity, and then other parts of the economy where activity's actually increasing. So you may follow individual stocks. Zoom is a good example of that. We're on Zoom right now, and Zoom's been a top performing stock this year. contrast that with some energy companies that have had a really difficult time with the decline in the price of oil and slowdown in economic activity. So it's not usual times, even for a recession, where there are winners and losers so far. And I'd say it's still really early too. We only have been in this pandemic for less than a year. And some days I think it feels a lot longer to all of us, but it hasn't been long, and we're not out of the woods. So this fall we have the election coming up. There's tension between the US and China, all kinds of other issues that could pop up. So we're not suggesting that it's going to be smooth sailing for the rest of the year either. So if we go to page 4, there's a couple other slides I like to cover. This is a good visual. This is showing data all the way back to 1926. So if you said, oh, wow, it seems like this, 1928, excuse me, this sell-off and recovery was really unusual. It was so quick. Well, your instincts were correct. So this blue line is the current sell-off and then recovery. And then we show the 80th to 20th percentile range and the average. So this is an outlier in terms of the steepness of the drop-off and then the rapidity of the recovery out of the trough, where we have hit record highs again in the S&P 500. So very rapid both ways. And then if we go to the next chart, this is to show, I think this is an aspect that many of us struggle with, is the disconnect between what's going on in markets and what's going on in the job market and the real economy. And a lot of the job losses we're seeing are in businesses that aren't even publicly traded companies, but we've seen massive job losses since the start of the pandemic, with some recovery, but it's still a period where a lot of people are feeling pain, and this is going to mean reduced revenue at the federal government level and then also at the state and local level. So that we know that impact is going to be felt from reduced revenue. If we go to the next slide, this is to show the level of intervention we've had from the Fed. So they've actually bought, this is not a typo, their balance sheet increase is over $3 trillion with a T since the pandemic. That's how much the Fed's been trying to intervene to stabilize markets because of the severity of the pandemic's economic impact.
Hey, Tom,
Yes.
to put that in perspective, out of curiosity, what was at the peak of the financial crisis, what was the balance sheet at the top, and what did it shrink down to and where we are today, out of curiosity, if you know that?
I can pull it up because actually I was reviewing this today, Joe, and the magnitude of this is so much greater in terms of how quickly it happens. So just bear with me a minute.
As far as quickness, but how about the peak of the financial crisis? What was the balance sheet?
Right. No, I understand. I understand your question. You're talking about the peak balance sheet?
Yeah.
Yeah. So if they were at about 4, and this is 7, over 7 now, compared to, let me see if I can get this for you.
I'm just curious. I mean,
Yeah.
it has no bearing really, but.
No, it is in terms of, so
It peaked around 4.4 trillion.
yeah, that's what,
And then what did it get down to? They get down to 1 trillion?
No, they got down
No.
to like 3.8, I think, something
Yeah.
like that.
And now we're back at 7?
yes, over,
Yeah.
looking at a chart here, I don't have a good scale for it, but yes, it was I think what Frank is saying is correct. There's no precedent in terms of size.
Wow, okay, all right.
Yeah. So,
Plus the steepness, as you said. I mean, it took them, a good year to move up from,
Yeah.
say, 2.5 to 4 in 08, 07, 08. And we just shot up over $1 trillion in a couple of months.
Tom, is there any expectation on the time frame over which the Fed will unwind some of that?
good luck with that.
Yeah, okay.
They've tried, right, to Frank's earlier point, started to dip their toe in the water and with tightening, and it was really difficult. And I personally am really skeptical of anything in the foreseeable future in that vein. I mean, if you look at on this chart, March and April, between the two of them was 2 trillion roughly, right? And then they kept adding after that, and they're still adding. So I personally remain very skeptical of anything along those lines. And I think it's going to be really hard. It's the same thing with, forget these QE purchases. Think about the programs, all the programs that the Fed has instituted, like the corporate credit facilities and the money market facilities and the muni facilities. It's not going to be easy to step away from those facilities now that they've been introduced, right? It gets complicated. What signal does that send to the market? So I never mind QE or QT. The idea of ending those programs, I think it's going to be very complicated.
Okay.
Yeah. So that's my perspective. So the reason I wanted to show it though is that it's important to understand the magnitude of what the Fed's been doing. And of course, you've had a massive fiscal stimulus package too, and we don't know. I actually was on a call today where this was a large asset manager saying they didn't think anything was going to get done by Congress this month, that they wouldn't be able to agree on anything. Hard to put a line on that, a betting line on that, but there's also been a lot of fiscal stimulus and probably more to come. So as I mentioned with the states, that's a huge issue, is the state and municipal budget gaps. So that's covering the high level. We have other pages on each of the markets. I'm not going to go through all of these in the interest of time. We have to go through 3 meetings tonight. So the next chart I'll cover just for reference is page 14. This is to put it more in context. It's through the end of June. It's not as of today, but it's important for the purposes of the endpoint we're using in the performance reporting. So as of the end of June, it was still a period where the best asset class was fixed income, right? So broad US fixed income was up over 6%. Large cap equity, defined as the S&P 500, was still negative through the end of June. More riskier fixed income, high yield was negative, EM equity, developed non-US equity, and small cap, they were all negative to greater degree. And then real estate, that's not private real estate, that's publicly traded REITs. So we're using that as a proxy for private real estate. And that's an asset class that's had some of the greatest impact from COVID. So the point of showing this is that in this environment, the best performing asset class was fixed income. And it does mean, though, with the returns we've had in fixed income and the yield environment we're in, so that's a combination of the very low treasury interest rate environment, the Fed's cut rates to zero, spreads have tightened a lot. The yield on the aggregate index, that's the broad investment grade index, is now just a little over 1%. So we're in a very low yield environment today.
That's as of June 30th.
What's that?
That's as of the end of June, not today.
Today we're a little over 1%. So we're about 1.2%, right?
Right, but the best performing asset class is probably U.S. equities, i.e. NASDAQ.
Oh, it definitely is. You mean as of today?
Yeah.
Oh, definitely. No question. My point was that it's important to understand that the returns have been strong for bonds, but it does mean that because of the yield environment we're now in, that the forward-looking return expectations are diminished in the zero Fed rate environment and overall low yield environment. So it's why you have active managers in fixed income. They do help, but it is a low yield environment. And the reason I'm bringing that up is that you've got plenty of diversification in the portfolio, but historically you would have gotten more yield out of fixed income, and that isn't totally predictive of return, but it gives you an idea of future return. So I'm going to stop there, and then if there's any questions, I'm happy to go through those. And after that, we're going to go into the pension performance.
The one thing about the bonds, you fixed income, it's all been, I mean, obviously the improvement is a result of capital appreciation. And it does seem like it's getting to a level where, when the 10 years yielding 60 basis points, even if whatever the 10 years you have that are trading at a premium, they're going to end up trading down to par. So the gains today could be losses in the future, aren't they?
Right, they could be. You've got interest rate sensitivity there, right? And credit spread sensitivity. Those are two of the main drivers. So to your point, Frank, if interest rates went up, if you have a duration of 6 and you have a yield of 1.2%, you've got a high level of interest rate sensitivity to moves up in rates and not much yield cushion. But we could stay in a low yield environment for quite some time, right? We're only 6 months or so into a pandemic, and we're in a very depressed economic environment from the standpoint of certain parts of our economy. So yes, we could see a rise in rates, but I think that at least from a Calum perspective, the base case today is staying in a lower yield environment for the near to medium term. It's not a rising rate environment.
Do you think we could get to negative rates like we see in some European countries?
So we debate this a lot at Calum, and Jay Powell's been pretty vocal publicly about saying that they don't want to introduce negative rates, that they do other steps before negative rates. But I don't think we should rule it out. I really don't, because of the conditions of the potential conditions that we could face in the economy. So, Rich, I think it's less likely than other places because they've done it, and it arguably has not worked well. It hasn't been stimulative the way that they'd hoped. So it's almost like the US has seen the beta test and it hasn't really worked, but I don't think we should rule it out.
The only reason why I mention is that it does give the potential for capital appreciation. So, I mean, it's
Right. Yeah, go ahead, sorry.
I mean, that's my only, really my only point is that, we have the potential for more than 60 basis points of capital appreciation.
Right, and I'm sure you've seen this, Rich. There's long bonds in Europe that have been amazing returners. And in fact, even the US, I'll give you the US long government index is up 21% this year, long govies. Now you've got a huge amount of duration sensitivity and thus volatility there.
Yeah.
But to your point, it's you've got that total return component that an active manager can try and exploit.
Okay, thanks.
Sure.
Any other questions? If not, we can move on to performance.
Let's do it.
So we show the actual asset allocation of the pension fund through June 30th versus the target. Not a lot has changed here from quarter to quarter. Liquid real assets continues to be above target, about 9% versus 6%, and that is really trying to make up for the wind down of infrastructure, which is now at a almost completely wound down, but at a 0% actual versus a 6% target. And then looking at this, it's been about 5 years since Callan's conducted a formal asset allocation study for the pension plan. I know we just did one for the OPEB this past year. And early next year, we'd like to conduct an asset allocation study with private equity slowly being wound down as we're not making new contributions there. Infrastructure at 0. We want to revalidate the asset allocation and bring that to the board in early 2021. Other differences in the actual asset allocation versus target, global equity long short at about 10.8% versus 8%. Domestic equity slightly above target, as well as absolute return and domestic fixed income.
Brett, given the, you go back up a second, given the run up since June in the equity markets, we're probably quite a bit over our target on equities now, right?
Tom, do you have the quarter to date numbers for the Russell 3 just to try and get a proxy? I think I have it. Bear with me.
Yes, I do. Quarter to date?
Yeah.
It's June 30, you mean? So Russell 3 since June 30
is
up
about 7.6%. Yep.
I think what Jim's asking for is our allocation where we stand right now. I mean, on June 30th, it was 28.18% equities, right? U.S. equities versus a target of 27, 121 million.
Correct. And we,
is
that what you're looking for, Jim?
Yeah, well, I'm looking at the first 3 lines really: domestic, global, long, short, and international. Where are we now? 4% over target. And that's probably what, 6 now at least.
Yeah, there should be a little bit of a run up, certainly within domestic.
One point though is that we don't have hard targets. What we have is, we have bands, and we are still, I'm sure, well within the band.
Oh, yeah.
And
You
your
are,
private equity too. It's important to think about total equity exposure.
Okay.
We're getting ahead of ourselves, but did the city put the cash into the kitty?
Yeah, Chitsime, could you speak on that?
Hi, this is Chitsime. Yes. There was for the fiscal year 2021, the total contribution is around 13 million. And I put in 3 million in July and 10 million in August. Right now, the cash available is around 9.1 million.
Beautiful. And how long do you think that'll last?
That should take me through December.
Beautiful. Okay.
Unless there's anybody who would
That's,
disagree with this, should we leave that in cash with all the volatility that's going on for Chitsime? Because we'll use that money up over the next few months.
I would
think
say,
so.
yeah, I would say yes.
yeah, I would,
It's only
I would,
liquidity.
I would agree with that.
Yeah. So going back to what Jim was bringing up, out of curiosity, where we are today, September 9th or something, within the bands, Tom, do we know where we are? That's as of June, right? Where what we're looking at right there?
as of June, I think in general, you would expect to see U.S. equity bump up a little bit. Again, the max is 32% for U.S. equity. International markets are slightly up, so we would expect to see that up a little bit. I think global equity long short is one area where liquidity, I believe, is quarterly with 90 days notice. And, you know, that's getting up closer to the top of the range there. So we could consider a small withdrawal from Blackstone if you wanted to raise cash, given that it'll take about 4 months to receive it.
Is that something we should look for potentially funding part of the first quarter of 2022's cash needs?
Yeah, I think we would agree with that.
And just pull it out.
Yeah, if it went to cash, and Tom, what I think a reasonable amount might be 4 to 5 million from Blackstone.
The email that I got from Chitsime, because we communicated on this, that she said in December, I'll need to request for cash of approximately 6 million. And so depending on what you want to take, if Blackstone is going to take us 4 months, is that what it is?
Well, we'll have to confirm the exact liquidity terms. I believe it's 90 days, quarterly liquidity with 90 days notice, which would bring us into the first quarter of 2021 would be my guess.
Is there a proposal then to take, if we took, say, 4 million out of Blackstone, and then we could take 2 million out of something that's more liquid to carry us through January until we get the money from Blackstone? Does anybody want to suggest that, or is it?
I'll make a motion that we ask liquidate $4 million from Blackstone Park Avenue, assuming it's going to take that long.
Joe, in our files, and like Britt said, we'll confirm it, but we have it as quarterly liquidity with 95 days written notice. So you could, if you submitted it before September 25th, you'd get it right after the end of the year.
That's perfect.
Yeah. So you'd have it in January at some point, probably. End of January, maybe.
I'll stay with that motion.
Yeah.
Any discussion or is there a second to that motion?
I second.
Any discussion on the matter?
Well, we need 2 million more, right?
We can
We
get
need
that
2
out of
million
the,
more,
out of the S&P fund or the index fund if we need to, at short notice.
Mhm.
Okay.
Chitsame, does that sound reasonable to you?
That's fine.
So we're going to provide them a written notice, Tom?
We'll,
reach out to Blackstone and work with Chitsame.
yeah.
Thank you. Okay.
So if there's no other discussion, we'll have a vote. You want to repeat your proposal, Joe?
I make a motion that we liquidate $4 million from Blackstone Park Avenue.
All in favor?
Aye.
Aye.
Opposed? Motion passes unanimous. Thank you. Brett, you want to
Great.
continue?
Yes, happy to, Frank. I think I'll just highlight here, assets up to 431.3 million. We saw over 40 million in investment gains during the quarter, so quite the bounce back, as Tom discussed earlier in his comments, change in the markets from the first quarter. On the next two slides, we're going to walk through performance. We show last quarter here, as well as last year, which is actually the fiscal year for the city of Norwalk, as well as longer term periods. A few managers that I will highlight, you can see within U.S. equity, LSV, a deep value manager for Norwalk, outperformed by about 400 basis points for the quarter. You can see a pretty remarkable return of 22.8%. This deep value strategy has really been out of favor over the last 3 to 5 years, which you can see in the longer term returns. And even with that outperformance for the quarter, for the trailing year, still some pretty significant underperformance. Cowen still maintains conviction in this firm and strategy. We do believe that value will bounce back at some point, and now is probably not the time to terminate a manager that's been out of favor for the last 3 years, based on its style. Tends to be a smaller cap versus the index, which has underperformed larger cap, and deeper value, which has underperformed less value-oriented strategies. On the alternative, you can see Columbus Circle up 42% for the quarter, pretty remarkable. In the last year, up 22% versus about 9.2% for the benchmark. So really incredible performance from Columbus Circle. Hopefully everyone saw the email that I sent out last week regarding some changes within Columbus Circle. If you recall, they were in early in January of this year. Cliff Fox was there, as well as one of his co-PMs. And we were a little weary of how long Cliff would continue to run the strategy. And we were informed that Cliff is retiring. And I think the pandemic accelerated that. And Chris Corbett, who's been a co-PM for a few years with Cliff, and he's been at Columbus Circle since 2006, is taking over lead of the strategy. And Mark Shapiro will be his co-PM, and Mark's been at Columbus Circle for about 15 years. We've had a few discussions with Columbus Circle to discuss the changes. Certainly significant. Cliff Fox is really the key person with this strategy and is responsible for pretty much all of the outperformance and returns that you see. Given that significant departure, we have spoken to Chris, the new lead PM. We believe that he's certainly capable, and we'd recommend putting Columbus Circle on watch, but do not recommend termination at this time. We'd like to see how the team takes control and really leads the portfolio going forward. One other change to Columbus Circle is, if you recall, their parent organization is Principal. And over the next few months, Principal will be taking over all back office operations for Columbus Circle and really integrating Columbus Circle's team as Principal employees, though Columbus Circle will keep its brand and its team together. That change we actually view as pretty positive. Columbus Circle, is mainly a small, mid and mid-cap manager. They used to manage a lot of large cap assets, which have deteriorated over the years. So given kind of where they are in the spectrum of investment managers and the scale that they have, we think really integrating with Principal is the right move and will help them save on the bottom line.
What do those changes mean to compensation of the key portfolio managers, if anything? The fact that they're getting folded under as employees rather than, whatever they were before.
Yeah, that what shouldn't change at all. As far as I know, Tom, if I'm speaking out of line, please chime in. But as far as we know, they will technically be Principal employees, but they'll continue to operate as a boutique manager owned by Principal. So they will still really maintain their own revenue stream, bonus pool, et cetera. So we don't anticipate significant changes to the lead portfolio managers.
Yeah,
I assume
I could give a little more, Jim, on, I think one thing it's important to keep in mind is that Chris is not an owner. So it's different than Cliff was an owner of CCI. And so getting bought by Principal was very material for him over time, being paid out for that.
Yeah.
So it's a totally different situation for Chris Corbett, as an example, where their relationship it's a salary bonus, and there is a deferred comp element of it. And some of that goes into Principal Financial Group stock. So it's a 60% goes into their own strategies and 40% goes into restricted stock of Principal with a 3 to 5 year vesting period. So it's pretty standard for a large financial organization, right? You have salary bonus and you have deferred comp, and some of it, which we want, is some alignment where they put some in their own strategies, and some of it's going into Principal, which they probably don't like, is my guess, but that's the way it goes with typically with the large financial organizations that are publicly traded. And I probably don't need to tell you that. So.
Hey, Tom, what's the percentage of Principal's revenue does Columbus Circle bring in? Do you know offhand?
No, we don't have that, but it is a valuable boutique franchise if you think about it, because they're really a small mid boutique at this point, Joe. The large cap team is done. They're terminating that team. Their assets had really dwindled. So in that sense, I think it's an obvious tie-up where CCI was less able to stand on its own because it's smaller and regulatory and compliance costs are up. And then it's still a good boutique for Principal that's got good numbers, good performance for small and mid. So we think it's, from that perspective, it does make sense. And Principal takes care of a lot of the headaches of the business side, the way the relationships work with all the services that they're providing. So back office, infrastructure, that kind of thing.
And I would just add, Joe, that Principal owns a number of boutiques, so Columbus Circle is not the only small investment manager that they own. So they've seen the scale and the value they can bring to these smaller managers to provide these back office operation services that, quite frankly, are really cost prohibitive
Yep.
at their scale.
Okay.
So we recommend keeping Columbus Circle on watch, and we'll continue to monitor any developments with the team and performance and keep the board apprised of anything that we see that may be concerning or might be good.
Thank you.
In terms of other managers in the portfolio, international equity, Artisan had a good quarter, up about 17.4% above the benchmark. They trailed for the year. If you recall, Artisan has a pretty heavy overweight to financials in the financial sector, and a lot of their performance is going to live and die by this financials bet that they've made. And it paid off. If you looked at the strategy a year ago, it looked pretty good, and financials over the last year have really struggled in general. Silchester, I know we discussed them at the last meeting, has protected well on the downside. Their absolute return, not as strong at negative 9.35%, but outperforming their benchmark by over 500 basis points, and continues to be a strong manager for Norwalk. BlackRock.
Excuse me, Brett, are they still open?
They are. So I know we discussed last meeting, Silchester hasn't had a open their doors to new investors. They've had a wait list that was some 7 years long. So they are still accepting new monies as far as we are aware. If Norwalk was interested, we can certainly make a allocation on the margin, but we don't. I think there was some indecisiveness between the board the last time we discussed this. But they're a very strong manager, and we think very highly of the team.
I don't know if there was indecisiveness, there was disagreement.
Disagreement.
Which is okay.
Certainly is. Within global equity long short, both ABS and Blackstone have done well. You can see for the trailing year, given all the market volatility, we've seen ABS up a little over 5% and Blackstone up 4%, well above their strategic hedge fund benchmark, though failing to keep up with these public market benchmarks. Within private equity over the last year, you can see some of these write-downs from the first quarter playing out, given the 1 quarter lag in the valuations. So while we saw the public markets down last quarter, this quarter we're seeing the private markets. On page 20 here, just highlight, fixed income managers, your core plus manager, MetWest, has done very well. You can see for both the quarter and the year, well above their benchmark. And Prudential had a good quarter, up about 40 basis points, and they're a very conservative core fixed income fund. UBS, your absolute return manager, again, their goal is really to provide a positive return in any environment. And you can see over the last year up over 4% versus their benchmark of negative 0.5%. So good to see UBS performing well as they have historically. And lastly, I'll just highlight PIMCO, up over 12% for the quarter. If you recall, we had them in recently as well. Their third pillar assets, which include things like emerging equities, emerging market equities, and other risk-on type allocations, perform well for the quarter. And interestingly, they've really tried to take a more conservative approach after June 30th on reading what the portfolio is doing on the margin, trying to, I think their outlook in general is not as rosy as some others. So they're trying to really diversify the fund and realize some of those gains that they had in the second quarter. So all in all, you can see a strong performance for the total fund, 12.92% for the quarter, well above the benchmark. And for the fiscal year 2020, 2.43% versus 4.16 for the benchmark. And most of that underperformance is driven by PIMCO All Asset and their return for the trailing year, as well as some differences in the asset allocations, so slight overweights and underweights within the total fund.
What's the time frame on the Macquarie funds?
I think there's almost, is there $19,000 in it, I think? So it's just a matter of time, I guess. It's more holdbacks as they finish all the closing documents to return the last bit of funds to investors.
Okay.
Any other questions? Britt, if you're done, we'll move on. Just
Yep.
one other point
Thank
I'd
you,
like to
Britt.
make.
Thank you,
Good.
Tom. That was very good.
One of the things recently, there was a study done. There was a request for actuaries, and Henry was excellent, and Ray. I also sat in, and there was a decision made to go with Kavanaugh McDonald Consulting. They're out of Georgia. They were quite professional. Their fees were, they matched the lowest fees that were offered to us. And they also are the actuaries for the state of Connecticut's pension plan. So we felt that that would be a positive possibly for the city. So anyways, I just wanted to pass that along. Is there any other issues that anybody would like to bring up? And if not,
Frank?
is there a motion for adjournment?
Frank, I would just mention that because they deal with the state, they said they'd love to come by and participate, especially if they're already in Connecticut. So we might be able to get them to talk with the pension board more than once.
Thank you, Henry.
Great job,
And
guys.
thank you for your good job.
Thanks.
If
Move
there's
to
no
adjourn,
other,
Frank.
no other business, is there a motion to adjourn?
Move to adjourn.
Is there a second?
A second.
All in favor?
Aye.
Aye.
Aye. Opposed? No. Motion passes unanimous. Thank you very much. We're going to now move on to OPEB. I'd like to call the meeting to order of the Pension Board, the OPEB committee. Is there approval of the minutes?
Motion
One
to
of the
accept the
facts-
minutes.
Accept the minutes. Joe, is there a second?
Second.
All in favor?
Aye.
Aye.
Aye. Opposed? No. Are there any public comments? If
There's
not,
no- Mr. Nash, there's no one from the public attending. I don't know if anyone emailed in any comments, but I don't see anyone from the public.
okay, thank you very much. So as a result of that, we'll move on to the performance review. Britt?
Great, thanks, Frank. Bear with me here. Everyone see my screen okay?
Yep.
Great. So here we have the OPEB asset allocation versus the target as of June 30th. Some slight differences in the asset allocation. You can see the overweight to fixed income, underweights to liquid real assets, international equity. So this target is reflecting the new asset allocation adopted by the OPEB committee or OPEB board. If you recall at the last meeting, the board did vote to rebalance $5 million out of fixed income into Vanguard International Equity and the PIMCO All Asset Fund. Those trades just settled on 8/13, we were told. So that's the main differences. There should be very close to target now that those trades have been executed. Here we just show asset allocation versus the target, including the ranges. And you can see OPEB up to about 102.2 million, about 20 million more than it was at March 31st. And all the asset classes are within their respective ranges. Here on page 30, we're showing cumulative returns. You can see last quarter and last year. Again, last year represents the fiscal year. Really strong returns for the quarter, up 15.17%, above the benchmark, as the higher allocation to equity versus the pension really came through in returns for the OPEB. You can see the passive equity indices did well as your fixed income managers, and PIMCO, with its really strong performance, led the OPEB for the quarter. And for the year, similar to the pension, the underperformance versus the target has really been driven by PIMCO's performance and the benchmark mismatch with the TIPS 1 to 10 index. As you all know, that PIMCO fund has some significantly different asset classes under the hood there. But no concerns, and you can see longer term periods, strong performance for the OPEB.
Chitsame, is there going to be money allocated from the city for the OPEB?
Not at the moment. We usually wait until the audit is completed. So in the meantime, whatever the contribution is for the fiscal year 2021, I usually use it to pay for the current expenditure.
Are there any expenditures that come out of, there's no money coming out of OPEB yet, is there?
Not from the OPEB trust fund.
Okay. Are there any other questions about OPEB?
When do we
If not-
expect money to come out of OPEB?
Not in our lifetime.
Well, I'm a little younger than you, Joe.
Not much.
Yeah. Yeah.
I'm sorry, I couldn't resist that.
Yeah, I'm gonna have to disagree with that statement though. But Henry, would you be the one who would make that decision, or Chitsame? You could comment on whether in the future there'll be I know that when we set up OPEB, they talked about the possibility that around 2020 money would be coming out.
Coming out, explain what you mean by that?
What I mean by that is that there'd be a drawdown, just as within our pension right now. I mean, we have a negative draw of about $18.5 million or so. And so will there be a time when there's a request for funds from the OPEB that's going to cause it to be reduced in size?
To pay for the post-retirement health benefits that we are obligated for.
Yes.
I haven't seen it now. I'll take a focus with the new actuaries and I can get back to you on that.
Thank you.
You're welcome.
If there's no more discussion, is there a motion for adjournment?
Move to adjourn, Frank.
Is there a second?
Second.
All in favor?
Aye.
Aye. Opposed? No. Motion passes unanimous. Next, I'd like to open the meeting for the Defined Contribution Committee. This one actually has, because this was back when, this actually does have the previous meetings, I believe, because they were recorded, that there weren't as many written minutes. However, this meeting was held in February. Is there a motion to accept the minutes? Are there any changes to the minutes?
February or is it January?
Pardon?
The minutes that were sent around were from January 8th. Right?
I have the minutes from February 12th.
Oh. Let me get those up.
At any rate, is there any changes to the minutes? And if not, is there a motion to accept?
Motion to accept.
Thank you. Is there a second?
Second.
All in favor?
Aye.
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 Opposed? No. Passes unanimous. A review of the plan? Is that you, Britt?
Hi, Frank. Do you mean the IPS?
Yeah.
Yeah, so I think one of the, now that we've, with Jerry and everyone's help, really taken the big step, we're moved the plans to Empower, we've created the new lineup's in place. One of the key documents that we want to establish is the investment policy statement. And we drafted, a relatively simple investment policy statement to really define the roles of the board, staff, consultants, Empower as the record keeper. And we wanted to get the committee's thoughts and the board's thoughts on the draft that we put together. We did highlight a couple areas, and I'm happy to show them on my screen, where we believe that it would be best if Norwalk's legal counsel reviewed a couple pieces of wording just to make sure that they are comfortable with the language. And essentially that is anywhere we mention ERISA. So being a government plan, you're not subject to ERISA, but we do consider ERISA to be the best governing body of defined contribution plans and really is something to aspire to. So anytime we mention ERISA, we're not saying that the plan will abide by ERISA, but we're saying the plans will aspire to abide by ERISA. And that goes into the advice that we give the board and how we monitor the investments and really best-in-class defined contribution trends and decision-making is really what our goal is with the mentions of ERISA. So that was, I think, the only area that we wanted to highlight, but happy to answer any questions.
Are there any questions?
I thought it looked fine. Aspire doesn't sound very solid, but I guess it's it seemed to be the lawyers are going to look at whether we need to go beyond the word aspire.
Well, I think it could be approved subject to the review of Norwalk's legal department. I think one thing that we do not want to do in an investment policy statement is corner the board into any of your decision making that is really not necessarily applicable, while ERISA is, something we think very highly of and they govern all the corporate plans in the country, it is not, the rules do not apply to the City of Norwalk plans. So our goal here is really just to not corner the board into any decision making.
Okay. Yeah, I'm fine with it. The lawyers are okay with it.
I have a question as far as when we met with the fire department representatives and they had asked if we could add some funds. Has that been done?
They never came back to us, did they?
No, so we set the lineup, we added, we'll go through that in performance, but I think the last we heard, the goal was to, one, make sure the transition to Empower happened. And as the board reviews the lineup and reviews the investment options, we can consider adding additional funds at a future date. And I have not heard anything since that meeting, which was prior to the transition.
And Ray, didn't you ask them to come back with some specific funds that they might be interested in?
Yeah, we kicked the ball back to them when they made this approach, and we said to them, give us more than just general ideas. Give us perhaps some examples of the types of funds that you were looking for. As I recall, they were looking for something that was very speculative, more than the ones we have available now. But we kicked the ball back to them, and I haven't heard anything from them yet.
Yeah.
Ray, just to add to what you said, it's important to remember too, Jim, that originally there wasn't going to be large cap active. So that was an accommodation to have more choice in active management. So there is the JP Morgan Equity Income Fund that's value oriented and income oriented, and the MFS Large Cap Growth Strategy.
Yep.
So those were added equity options in response to that initial feedback. And then to Ray's point, the old plans had very speculative options that we would never recommend, like sector funds.
No, I totally agree. I think
Yeah.
it was smart to kick it back to them, and I'm happy they haven't replied.
Should there be any discussion? You sent an email out about the litigation, possible litigation in these contribution plans. And I was wondering if there's a fund that we felt is not performing adequately, but somebody had money in that fund, would we change the fund, or would we add a fund that was similar? For example,
Yeah,
say
Frank.
there was a fund. Go ahead.
So essentially it would work almost identical to how the pension fund operates. So as we monitor these managers on a quarterly basis, and we review performance, and we review organizational changes like Cliff Fox retiring from Columbus Circle, if we ever reach the point where one of these funds simply isn't cutting it, or we don't believe that they will, and we think that they need to be terminated, we will conduct a search and bring a short list of candidates to the board. We can interview the finalists if necessary, like we have done. And essentially, if that new manager was hired, we would do what's called like-to-like fund mapping. And so any participant with a balance in that fund that's being terminated would be mapped to the new fund unless they opted out and not elected to go somewhere else. But essentially, it would be like to like. So if we were replacing a large cap growth fund with another large cap growth fund, all participant assets would go from the terminated fund to the new fund in one transfer.
Thank you.
Would we be opening up a can of worms if we put a email blast out to the participants and seeing how things are going, or just leave it alone?
Leave it alone.
No,
All right.
I would. It's the board's responsibility to monitor.
Yeah.
To monitor the performance and the choose the investment managers. So
Well, I don't mean that part of it. I mean the whole transition to it all. But no, I get it. Leave it alone.
Well, one thing I think, Britt, that we should add that we talked about is periodically you'd want to have Empower come before the board at least once a year to give an update. So that would include what's the participant communication campaign for the coming year? What are the communication initiatives, education initiatives, to your point, Joe? And it's part of that is also feedback. What are people calling the helpline about? What are the questions that we're getting in the meetings? Are there any issues? So that should be part of the, now that this has been settled, we have the new lineup, the new record keeper, it's in a much better place. But part of the monitoring is having what's called the plan administrator, Empower, come in and present on the plan administration.
Okay. Makes sense.
Yep.
Ray, can you comment on whether or not the feedback from participants? Or I don't know whether Jerry, if she's still there, whether the two of you, one of the two of you could just tell us how you feel that the transition went and that are people satisfied?
All in all, I think, go ahead, Jerry.
I have not really heard, once the initial thunder about rolling out the plan subsided, I have to say that it's been business as usual with the plan. I have not heard any negative feedback. Employees seem to be adjusting and are actually pleased and comfortable with the new plan. I have not heard any negative feedback, even with going back to your earlier discussion on adding funds. Again, I think there was some robust interest in the very beginning, but that seems to have subsided. That's not to say that we can't entertain the idea of adding funds or changing funds if we need to replace something with something that's not performing up to par. But there's no what I would call lively interest in adding any funds to the lineup at this point. Now, I don't know what Ray may have heard from out in the field, but most of the employees, especially of fire and police, they know who I am. They will reach out to me if there was an interest, and I've not gotten any feedback or any requests about changing the fund lineup.
Yeah, my opinion would be to echo what Jerry said. The fact that we haven't heard any feedback or negative feedback, to me, is a positive sign. We met with significant resistance, which typically happens when you want an employee workforce to change something they're used to. I have not heard one negative comment about performance. In fact, a handful of people who know who I am and the role I played in this conversion have said they're very happy to see their Empower report and see they're only being charged $7 a month for the maintenance of that account compared to what they used to be charged. So all in all, I think it's a positive exercise and was to the benefit of the employees, which is why we did it to begin with.
I would, if I could, I'd like to add a point just as a participant. During COVID, every 6 to 8 weeks, they're sending an email blast to everyone saying, I know you're a participant. If you have any issues or concerns, please reach out. I was pleased with that active involvement rather than just passively waiting for people to contact them or complain. So I thought that was a very big positive.
That's excellent to hear.
And Frank, to Tom's point earlier, we would like to have Empower in maybe towards the end of the year to review the transition, review the communication campaigns that Henry's talking about, as well as the campaigns towards the participants that didn't transfer over. So remember all the assets that were locked up in annuities. As you'll see in the performance report, a number of people did not transfer over, and part of Empower's job is to continually communicate with those participants so that they're aware and know how the process works should they want to ever transfer that money back into the plan.
Yeah, and just as a footnote to that comment, I would say since the implementation of the plan, I've gotten, I would say between 15 and 20 requests from AXA participants whose contracts had expired to roll those funds over to Empower. And so that was actually surprising to me that there was as much interest in, at the end of the day, moving their accounts from AXA over to Empower, when again, as Ray pointed out, the initial reaction was some pretty strong resistance.
What's the total number of participants that that stayed with AXA?
I can look that up when I have access tomorrow, and I can email you. That's not a problem, because I kept
That's fine.
records of everybody who requested.
You can tell us next meeting. That's fine.
Yep.
Are we getting any reports on who's reaching out for education, whether they're
Yes.
using the
Yeah,
website, anything like that?
Yeah, absolutely. I'm glad you mentioned that, because I would like to share with everybody that Daryl, who was the assigned investment counselor, if you will, for lack of a better word, who did some of the initial on-site meetings with employees at City Hall, as well as at DPW and fire and police stations, has continued to cultivate relationships with our employees. He's reached out to them, they've reached out to him, and he's been very valuable in working with participants on their individual portfolios, and continues to do that. So that's a real positive, and I'm glad that he has formed those relationships with employees going forward, especially in the absence of being able to do or continuing to do some of the live meetings that we had initially set up due to City Hall's closure. He's doing meetings similar to what we're doing here, phone calls, emails. So he's still communicating with employees, assisting them with their portfolios, even if he can't do it face to face.
That's good to hear. Thank you.
Mm-hmm. You're welcome.
If there are no other questions for Jerry or Ray, or if they have no other comments, we could go on.
Did we approve the plan IP, or are we going to wait until the lawyers come back? What are we going to do on that?
I would think we should wait until the lawyers, look at it.
I am unaware of city council reviewing this document, and if that's the case, then before you guys act on it, I would like to have them take a look at it and bless it.
Thanks, Ray.
Great. Thanks, Ray.
Great. So we'll wait to hear from Ray, and we'll bring it back as soon as we can.
Thank you, Britt. If there's no other discussion, we'll move on then to, if you want to just review where the investments are, et cetera.
Sure, Frank, happy to. I'm going to share my screen one more time. So now that both plans have transitioned, this is the new performance report, and essentially we'll give an overview of the 401A and then the 457. And then since both plans have the same investment options, we'll review the investments like we do for the pension and OPEB. Here we're showing the asset distribution of the 401A plan. You can see about 6.5 million, up about 1.2 million from previous month. If you recall, it's been a while, but the default investment option in this plan are the target date funds. So if a participant does not make a choice, they are defaulted into the target date funds. And you can see they make up over 93% of the assets, which we view as a positive for participants, as typically this helps them make asset allocation decisions for them instead of them over allocating to the various investment options. On this page, we just show, again, looking at the allocation, point you to the bottom chart, which shows the change in fund values, which includes both the market moves, contributions, transfers between funds, and any withdrawals. And as you would expect, the target date funds increased the most over the quarter, about 1.1 million.
Hey, Brett.
Yes.
The default mechanism to the target date funds, how's that determine which target date they're going into?
So It's by their date of birth. So
That's it.
each target date fund has a specific range of dates of birth. And given where, say, a 25-year-old participant is, he'll be in one of the longer 2060 funds when the expected retirement would be.
Thank you.
Here on page 10, we just highlight the contributions. So where are participants putting their assets during the quarter? And you can see, consistent with the asset allocation, 92% going to the target date funds. Again, I think this is consistent with past 401A performance reports where the default is the target date funds, and that's where most of the participants' money is going each quarter. As we turn to the 457 plan, you can see assets as of June 30th, about 37.4 million, up from 32.5 million. I will point out here that all of these transitions for the 457 plan, this is a much different transition for this plan. It's much more mature. A lot of participants have money here, and this is really the first full quarter that participants can get on the website. They can make changes to their funds, changes to their contributions. So you'll see a little difference between this report and the 401A as we look at contributions and where investments are allocated. I'll just highlight here target date funds. Again, this was the default in the transition, was target date funds. So 76% of participant assets within the target date funds. And you can see both the active equity and passive equity options, as well as stable value, also have allocations about 6 and 8%. Bottom chart here shows the change in fund values for the 457. You can see a little more variance compared to the 401A. While the target date funds increased the most, you see the passive and the active equity options also increased pretty significantly. And I thought this page was interesting, that's why I mentioned it earlier, but you can see the contributions for 457 participants have changed pretty significantly from the asset allocation at the end of the quarter. And again, with the market volatility at the end of March, new plan transition to Empower with a new lineup, I would suspect that a lot of the stable value is one in reaction to the market volatility, and a lot of the variance here is in reaction to participants having a full quarter to understand where their contributions are going, how they're allocating, and how they want to allocate. So nothing wrong in this scenario, just wanted to point it out. In terms of performance, the Capital Group American funds, here we show really, they've only been in the plan for the quarter, but we show longer term returns here just so you can have an idea for monitoring purposes how they've done. And we show the specific index that the manager is using, as well as Callan's index, which is the median manager for that specific peer group. And you can see for the quarter, really strong absolute performance ranging from 8.3% to over 19%. And competitive performance versus both the manager's benchmark as well as the median peer, really across the fund series. So strong performance from the American funds, as we would expect. They have a higher equity allocation within their fund series than most of their peers, which, given the strong performance in the quarter, we would expect to see them doing well. And here on page 18, we show, if you recall, there, in addition to the target date funds, there's a suite of index funds as well as active funds. And you can see the index funds track their index adequately and have done fine. And with an active equity, you can see JP Morgan Equity Income Fund slightly underperformed. Some stock selection there within financials that dragged on relative performance, but you can see their longer term returns certainly very good. To highlight the MFS Large Cap Growth Fund, I know Tom mentioned in his earlier comments how much growth had outperformed and how much growth stocks had really contributed to the return. And I mean, the Facebook, Amazon, Microsoft, Google accounted for about 35% of the return within the index. And this MFS Large Cap Growth Fund is one, they have about a 10% underweight to technology. They really seek high quality companies and they really want to protect on the downside. So while they underperform by 700 basis points, given the really difficult market and the stocks that drove the index return, the manager's style and seeking quality and trying to protect on the downside. And it's not a very high turnover strategy. They really hold on to their securities and have conviction in them. So we'll continue to watch them, but I think in general, when you dig into how they are, what their philosophy is, and how the index reacted, it's not all that surprising in such a volatile market. In terms of other funds, the MFS International Equity Fund had a strong quarter and strong one-year return. GW&K underperformed for the quarter. And in fixed income, you can see MetWest, the same manager in both the OPEB and the pension, had a strong quarter, and the Invesco Stable Value Fund performed very well. The only thing I'll highlight here, and then I'll stop, is the expense ratios on the right side of my screen here. You can see they, for the target date funds, all rank in the 80s. So we need to highlight this on a footnote, but that means that they're in the cheapest quartile of target date funds. So they're extremely low compared to their peers. So a really good sign there on all the target date funds and really across the board. You can see on the right, all of the index funds, all of the active equity options, for the most part, are all within the top quartile, or excuse me, the bottom quartile or the cheapest quartile of fees within their peer universe. So that concludes my remarks. Happy to answer any questions on the DC plan. I think I'd like to congratulate Ray and Jerry for crossing the finish line, and we're excited that the new plan is set up and the new investment options are off and running, and we'll continue to monitor them going forward.
I think the whole board shares your view, Britt.
Yeah, definitely. It's Ray or Jerry. It's Jim Hendrickson. Have you heard any differences in the feedback from the 401A participants and the 457 participants?
Not on my end, no.
Now, keep in mind who they are. The 401A people are the relatively newly hired, relatively younger people that are not paying much attention, generally speaking, to these type of benefits that they get. So they migrate right into the target date funds and don't pay much attention to them because they're 29 years old and they don't really care too much about it. So we haven't gotten much feedback from them at all. The interesting, one of the things I find most interesting here on the 457 account is the fact that close to 80% of the money is in target date or unmanaged funds. So all the noise we heard about, I want more choices, is not supported by the $37 million, over 30 of it going into unmanaged accounts.
Yeah.
But I don't think that's unusual for a workforce. I think by and large, particularly a workforce like ours, they're not going to, with rare exception, try to manage it day to day. They're just going to put it into an account that someone says, put it here, and they'll leave it there for 20 years. And I think
I recognize they're very different groups. That's why I asked the question. That's good to hear.
Yeah.
Thanks.
To Brett or Tom, what about Empower? We've heard that the employees are satisfied. I think originally we thought there might be over $50 million moved. It's a little less than that. It was a range, I think, of between 40 and 60 million. Are they satisfied with the amount of funds that have been allocated?
We haven't heard anything from Empower. I think, part of their job is to, one, transition the assets that are able to be transitioned, and two, work with Norwalk and the participants from the AXA plan to try and transition them as the lockup fees disappear and fall off. So I think that's one reason we want to bring them in, not to really say, are they happy with the 37 million they got, but more of what's the plan to continue to target participants, continue to grow participants' contribution rates, and really encourage participants to hopefully have a successful retirement.
Yeah, and Frank, that's another reason we think it makes sense to have them in, right, is to give that type of report to the board. So that's standard monitoring for the board. It's not just the investment side, it's the functions of the plan administrator.
When would we have them in?
I think we should have them in at the next time that there's a DC defined contribution meeting.
Okay, yeah. Makes
Ray,
sense.
is there any idea as to when meetings might be held at City Hall?
As of right now, there are, As of right now, there are only one or two instances where we're actually having meetings in person. I think that the general approach we've taken with the city year to date is to be very safe. And now that we're going to start approaching fall, unless something significant happens, I don't really see us going back to across the board regularly scheduled in-person meetings in this calendar year, quite frankly.
Thank you. Are there any other points of discussion as far as the DC plan? And if not, is there a motion for adjournment?
Motion to adjourn.
Is there a second?
Second?
All in favor?
Aye.
Aye.
Opposed? Motion passes unanimous. Thank you very much, everyone, for attending the 3 meetings.
Thanks, everyone.
Thank you for your careful stewardship, Frank.
Thank you. Stay safe.
Yeah, good meeting.
Stay safe, everybody.
Well,
Bye-bye. See you next month.